This is Mike from Walnut Investment Capital Group. Welcome to our July 2021 investor call. I have a lot to talk to you about, so let's get started. People often talk about the concept of growth versus value stocks. You have growth stocks, which are considered stocks with a higher price to earning ratio, higher price to book ratio, faster earnings growth, hence the categorization growth stock. They usually have no or very low dividend yields. Versus value stocks, stocks that have lower price to earning ratio, lower price to book ratio, or they have slower earnings growth, but they tend to pay more dividend. So this people often talk about which growth or value to own. I'm not going to tell you that you should own more of one or another. I think both of them, they are good growth stocks. They're also good value stocks. There are also bad value stocks, and there are also, and actually a lot of bad growth stocks. So I like to not think about this war between growth or value, but rather think about having good stocks versus bad stocks. Because like I said, you can have good growth, but you can also have bad value. So there's not necessarily a war between them, but rather I would like you to think about good stocks versus bad stocks. And here are just some kind of questions that we apply to stocks when we pick that I'd like to share with you. You want to ask, is the growth sustainable? And is that sustainable growth something that you can put a value on? You can give it a number. For example, what is the percent growth, or how much this company will earn in the future? So it's very straightforward. Is the total addressable market big enough to sustain growth? Does the company have the ability to stay competitive? Is there a competition in the field? How would the company stand itself out? Is there a return of capital to investor, or does the company concentrate more on accelerating its revenue growth by investing in the company itself rather than returning capital to investor? Is there international expansion? We know that the international market is much bigger than the US market. Does the company have operations overseas? Can the balance sheet support strong growth? Is the stock expensive in the next 5 years? We usually use the concept of the out years or the future. When you're pricing the stock this way, and given what it can do in the next 5 years, is that price expensive? And then does the company have the right management? Does the company need macroeconomic growth to meet the numbers? And then lastly, can the company maintain or grow its margin of operation? So we like to keep in mind these 10 criteria for judging our companies, the stocks that we own. We need to keep these criteria in mind, try to give them a score from a scale of 1 to 10. And then the stocks have to be greater than a 5 for all of these criteria for them to be in our portfolio. So like I said, instead of thinking growth versus value, why don't we think about them as good stocks versus bad stocks? Let me give you an example of a value stock, but it has gotten expensive to the point that it shouldn't be a value stock anymore. So if you look back last year, around October to December, the price to earning ratio for the stock was relatively low. Back then, you could call it a value, but when you're up here, I don't see any value here. Stupidity here, maybe? And this is something that we actually owned, and we're now trying to own up to our mistake here, and we didn't pay attention to it up there. and we were pigs. We wanted it to go much higher. So it wasn't. We don't think it was. There was any value up here. This was too expensive. This is Freeport McMoran. It was on the tailwind of higher copper prices and inflation, and when prices peaked. Certainly, you have Freeport McMoran peaked as well. So this is an example of a value stock that has gone up too much, ran up too much too fast, that it wouldn't be value anymore. And on the other hand, let's talk about a growth stock, Microsoft. When it was here, you certainly see a lot of fear around the fall of last year, when you have this debate about stock market getting expensive. Here is an example of paying for growth that is sustainable and that is strong. As you can see, for the past year, Microsoft has been on an orderly uptrend, while the price to earning ratio actually has been staying relatively consistent. So we're now here, although it's a little bit high, but we're just getting back to that peak where we were last summer. So for a year, the price to earning ratio of Microsoft stays essentially the same. So this is an example of good growth. It is a growth stock, but it is sustainable growth, and it's value to us. So now let's talk about the state of the U.S. economy, judging by the action of the 10-year Treasury bond. And this is something that for newer investors, not necessarily, you would not necessarily know that the stock market, one of the big factor at play for the stock market is actually the bond market, which is boring, but it is important to understand. So you can see that the price of bond shoots straight up during the depth of the pandemic, so around March of last year. Bond price shoot up. Usually bond prices go up when there's perceived economic slowdown, and indeed we have. It was a pandemic, so bond prices shoot up. And then since last fall, bond prices, slowly fall, which was, happening along the time when you have news about the vaccines, and we kind of could see the end, the light at the end of the tunnel. So you can see bond price, just drifting lower. And then earlier this year, we see that bond price was going down at a much faster pace, and that was when we were vaccinating a lot of people. People could see return to normalcy. Now we're here. All of a sudden, we see it, bond price drifting back a little bit. If you think that, getting the vaccine to everyone and the economic activity picking up and returning to normal, bond price would keep going down to levels before the pandemic, right? But for some reason, we stopped going down in bond price. We went up. And like I said before, bond price going up is indicative that the bond market is perceiving there's some economic slowdown. And that's troubling, and that's worth getting to the bottom of. But bond price, or bond, the action of the bond market is for some reason saying that we are at peak economic growth right now. There is some perception of an economic slowdown. That's why, again, you see bond price starting to drift higher. So this is something to keep in mind. This is what the market is currently thinking, where we are. I talked about this in our last month's investor call. This is talking about the a cycle, an economic cycle. Of course, we were at the depth of the pandemic here, and we started to recover. You see stocks recovering as well. Commodities overheated. Commodities may have peaked. Actually, a lot of stocks like Freeport-McMoRan, Nucor, down 20% from their peak. So the market thinks we're here. The Fed is going to have to market things that the Federal Reserve is going to have to hike interest rates soon, and that will create a slowdown in the economy. So I'd like to kind of give you just let you know about what the market is thinking about the state of the economy. So now let's talk our stocks individually, and in this month's edition, I'm going to pepper in some trades that you can take because next week we will have a lot of stocks that report. So let's get started by talking about NIO. This is again a Chinese electric vehicle company. I write here some factors that we know can affect the price of NIO. Of course, you have the U.S. macroeconomic growth that can affect the price of NIO. You can see at the beginning of this year where bond prices was falling dramatically, interest rate, the treasury yield increased, and that was hurting growth stocks, of course, and NIO was one of those that got hurt. So, of course, the U.S. macroeconomic growth can hurt or help NIO. You can see that the movement up of NIO from May to about July here happened concurrently with when the bond price was going up. The semiconductor shortage also played a role. You can also have the uncertainty regarding Chinese regulations that's hurting Chinese stocks. Of course, NIO is a Chinese name, and then the company's growth will determine its stock price. And now let's talk about what's happening to those 4 points. Now you have rates going lower and relatively stable, so that should be more favorable towards growth stocks. In terms of the semiconductor shortage, the CEO said that expect this shortage to hit companies the hardest in May, and then it should ease in the third quarter. So NIO is going to report its second quarter earnings end of September. Yes, so that will we may see some slowdown in the reports, but that's expected. So the market knows that because the CEO said that. China uncertainty, that remains still uncertain. Stocks in the Chinese group are getting hit. You have, for example, this Friday, China was banning some education companies, some sort of regulation. So those education companies, for example, TAL, was down a lot. Like, you should take a look at them. Unrelated companies like Alibaba or NIO or XPeng Motors also got hit, and so the uncertainty around the Chinese government, the People's Republic of China, still is a factor that's hovering around the growth of these Chinese stocks. And then in terms of, lastly, companies' growth, we're reading the data in terms of delivery numbers from NIO, and it still remains good, and it's not something for us to concern about. Demand is still strong. Company is still getting good demand from consumers. Next, we'll talk about Ford and GM together, General Motors. Some factors that affect the price of Ford and GM include, of course, macroeconomic growth in the United States. These are kind of currently being regarded as cyclical stocks, so they should get a boost when um, the economy is perceived to be growing strong. Um, it is also affected by the semiconductor shortage. Certainly, you see that the shortage has been hitting Ford and GM prices. And then lastly is their transition to electric vehicle. These are stories of original engine manufacturers that they're trying to transition to compete in the electric vehicle market. For example, you have Ford saying that their electric F-150 is going to beat Tesla's Cybertruck. So you have yeah, I've talked about those. Now let's look at this chart of Ford and actually have a trade for you. So if you draw a line through the bottoms from the pandemic to now, you can see that the stock, you can draw a trend line that pretty much every time there's a drawdown, it hits this trend line and then it moves up, okay? And from the pandemic until now, you can see these from peak to trough, you can draw kind of a couple 20% pullbacks. So you had a 20% pullback here, about a 25% here, about a 10% pullback here. So from the recent high to the recent low, you can draw a 10% a decrease here. This is a 20% here. Right now, we are at the end of a 20% correction, and we are sitting right on this trend line. I think we are going to bounce. The technicals suggest that we are going to bounce again to new highs, probably to 18 or optimistically to $20 this time. So what kind of trade are we taking? We want to buy a $14 call dated September 17. We will sell a $16 call dated September 17 as well. The cost to open this trade is $55. The max loss that you will get from this trade is that just the cost of this option, $55. Max profit you can get is about $145. So what is happening? You're buying 100 shares of Ford at 14, and if Ford goes above 16, then you're selling 100 shares of Ford at 16. So the difference is 2 points, and so you make $200. So 2 points, $2 times 100 shares, you're making $200, but you have to subtract out the cost for you to open this trade at the beginning. So subtracting $55 from $200, it gives you about $145 for profit. Next up, we have Boeing. Boeing has been bad, has been painful to own. Our average price for this stock is about $250. We got in about this time. Multiple factors that affect the price action of Boeing. Certainly the travel recovery for the United States and as well as the world. Delta variant is currently affecting Boeing. Another big theme or thesis of our investment is the Chinese recertification of the 737 MAX. There has been some chatters that China should recertify Boeing by the end of 2021 or this year. There are fears of the new CFOs doing equity offering because the balance sheet for Boeing has been bad. And then lastly, we're very upset with the company's execution. You hear news, and we write about those news about Boeing, not being able to execute. For example, the 787 Dreamliner, there has been some delays in terms of delivering those. So there are inventory issues. The FAA, the Federal Aviation Administration, has not been happy with how Boeing is handling its operations. So on the execution side, it has been bad. Boeing reports next week. I would not be surprised if they mess up something. But we own Boeing for the out years, for the future. We think there's an uptrend in the stock price, and that's why we continue to suffer the pain in Boeing. Next up, we talk about Wynn Resorts. This multiple factors that affect the stock. You have the recovery of travel in the United States. Certainly Delta variant has been hitting the stock. But since Wynn has operations in Macau as well, so Asia's COVID situation also determines the stock, how the stock performs. So in terms of U.S. recovery, the traffic in Las Vegas properties has been very good. So there's no worry there. But in China, there has been there has been a lot of lockdowns. The Chinese vaccine is not as effective as the Moderna vaccine. We're hoping that the Chinese government will agree to use either Moderna or Pfizer's vaccine, because frankly the Sinovac is not as effective. But also if they don't, then we try to trust China's ability to control the virus. They did well last year. Okay, next up we have we have Walmart. Multiple factors affect the price of Walmart. You have macroeconomic growth for the U.S. economy. Walmart is a consumer staples stock. It is considered defensive. So when there's perceived economic slowdown, consumer staples should do well. So Walmart, we think, is rightly positioned if the economy indeed is slowing down. Second is Walmart's transition towards e-commerce, so the Walmart Plus. The stock has not been doing well because there are pieces from analysts saying e-commerce for Walmart, the Walmart Plus initiative, is not good. We're unclear on this front, but we have to trust that the company will do something to address this point. And then another point that we want to make for Walmart is the extremely cheap valuation. So when you look at the EBITDA for Walmart, it's trading at 10 times 2021 EBITDA. Costco, another retailer similar to Walmart, trades at about 20 times 2021 EBITDA. Target trades about a 14 time 2021 EBITDA. And Dollar General, another retailer, consumer staple stock like Walmart, trades at about 13 times 2021 EBITDA. So there's a case to be made about the valuation for Walmart here. Next up, we have Alibaba. This is a pain. The biggest factor that's affecting this stock right now is Chinese regulation uncertainty. Market is not reacting to incredible earnings that this company is delivering. Growth in Alibaba is incredible. It is a tech company in China, and you know about the market in China. It's incredible. But the U.S. market, so this stock trades on the U.S. market. It is not trading on the fundamentals anymore. It's trading based on what is happening in China in terms of how the government is regulating these companies. So that's why I put, China uncertainty in all caps, and I underlined it. That's because that's what has been happening. I wrote a piece about what we think the Chinese government, China, the PRC, People's Republic of China, what we think they are doing. And our conclusion is that we should endure this pain. This is incredibly cheap. we believe the company will come out alive. So you should read that piece that we published. If you haven't, um, kind of defending why we should be buying Baba at this time. Okay, next up, Morgan Stanley. This is a financials company. What has been affecting the stock the most is, certainly the U.S. macroeconomic growth, but more specifically interest rates, because this trades together with financials. However, what makes this company stands out from traditional banks, and that's what this company is trying to do, is transitioning into wealth management. So you can buy Morgan Stanley here. We certainly like Morgan Stanley here. We initiated the position at all-time high. That's how much we like the stock. You should read this piece published on our website here. Kind of why we're owning this stock, essentially, if you haven't. Next up, we have Apple. Apple is reporting sometime next week, I don't remember, but let's talk about what factors affect Apple. Certainly macroeconomic growth. Apple is a secular growth stock, so when there's perceived economic slowdown, Apple as a secular stock should do well. The product cycle for Apple, usually the stock runs up to about September, which is when they unveil their new product. And then after that, it kind of underperforms. So you can see this run up here and then just kind of, not doing anything for a year. And then the analyst cycle, you have this company, Apple, everybody knows about, but you have analysts keep downgrading and upgrading the stock. So what we like to say is just own Apple. Don't trade it around, because this stock is crazy. One day it can be down because one analyst say that Apple is not too good, and then it's up the next day because another analyst at a different bank says, this is incredible growth. So that's why we call it a stock that you should own and don't trade. Despite that, the technical is setting up quite nicely. So Apple broke out of all-time high just a couple days ago, retested that. You remember Monday's sell-off, so Apple retested that. We think if it can get above 150, it can go higher. So we're proposing this trade here. You're buying a $150 call dated 17th of September. And I'm sorry, this should say sell. You're selling a $165 call 17th of September. So there's a 15-point difference there. The cost to open this trade, you're buying this call, you're selling this call, is $400. The max loss that you will incur is just the $400, but the max profit that you can get is about $1,100. And again, that's because the difference is 15 points. If Apple gets above 165, what's happening is you're buying 100 shares at $150 per share, and you're selling at $165 per share. So the difference is $1,500 for you. But since you have to pay $400 to open this trade, your max profit is going to be $1,100. So that's Apple for you, reporting next week. Next up, you have Nucor. This is a steel company. The biggest factor that's affecting the stock is U.S. macroeconomic growth. Again, I pointed you at the beginning, where are we in the economic cycle? You can see that lately Nucor has been beaten up. I think it's down about 20% from the peak here, because the market is saying that this is as good as it gets for Nucor. However, you have to read the conference call. The company just reported last week. They're saying demand is strong, and you're going to see a record third quarter for them. So we wrote a piece this morning about Nucor. We report that earnings for you. So if you own Nucor and you have been kind of doubting the stock, you should read this piece. Next up, we have Kinder Morgan. This is an energy infrastructure company. Two factors that affect this the most, you have the again, macroeconomic growth, and specifically oil. So oil prices, affect oil stocks. Here we're plotting kind of the price action of Kinder Morgan and the price action of U.S. oil. You can see the move is pretty much similar, although it's not going to get. You don't get that much of a correlation because Kinder Morgan is not kind of digging oil out and selling oil, so oil price doesn't affect Kinder Morgan's operations that much. Oil demand does, because again, it's an infrastructure company. They have pipelines to transfer oil, to store oil. So again, this is an infrastructure company. We know that oil demand is strong. You have the economy. Only part of the U.S. has been reopening. The world has not reopened yet. You don't have the robust travel that you had before the pandemic. And then the second factor is actually the treasury yield. So you have a batch of stocks that pay very high dividend, and Nucor is, I'm sorry, this is Kinder Morgan. Kinder Morgan is in that batch. KMI pays 6% dividend annually. That certainly beats the treasury yield you're getting, which is about 1.2, 1.3% right now. When you have treasury yield falling, the market tends to favor higher dividend paying stocks. So Kinder Morgan is one of them, and that's actually why we keep owning this stock, because it pays 6% dividend. That's good. So just own Kinder Morgan, don't trade it, own it for a long time for stable dividend. And then next, we actually just initiated this position late last week, and that's Diamondback Energy, or the ticker FANG. This is an oil stock. So the price action is more sensitive to the price action of oil. This has good balance sheet, so this is a way to play if you're bullish on oil price. We just tried to dip our toe in this company. Not a big position, just as a way for us to position ourselves if oil prices go higher. So Diamondback Energy is a good way to play oil. My favorite stock, Advanced Micro Devices, AMD. Okay, this company makes chips, competing with Intel, competing with NVIDIA. Macroeconomic growth affects the price of AMD. This is a growth stock, so again, growth stock tend to outperform when the economy is slowing down. The semiconductor shortage has been affecting the performance of AMD, but we're getting news that the shortage is easing up. So we'll hear from the company reporting next week. We'll hear more about that. The competition with Intel is affecting this stuff. So you see this huge move last July. This happens when the market realized that AMD is beating Intel. Everybody knows about Intel. It has a longer history. It used to be a giant in the semiconductor space. Now AMD is beating Intel. It has been beating Intel. So this competition, how well AMD is staying ahead of Intel, is going to affect the stock price of AMD. And so far, AMD has been beating Intel by a mile. So last, I believe Thursday, at the close, Intel reported, and it proved to the market that Intel is so far behind AMD. On Friday, Intel was down 6%, while AMD rallied 1%. Actually, 1.03%. So that kind of gives you the perspective about AMD versus Intel. Something else that has been affecting the stock price is this Xilinx acquisition. So AMD is buying Xilinx to expand its operation. This is great. Once this deal closes, it's going to change. It's going to transform AMD. AMD is going to be even more competitive towards Intel. It's going to stay outperformed compared to Intel, and it's going to compete with NVIDIA. So this is very exciting. But this deal, it's a stock deal. So there has been this trade going on where it's called an arbitrage trade, where traders would short AMD and buy Xilinx, which is another company that AMD is buying right now. So they short AMD. Shorting is borrowing shares to sell it. So they've been shorting AMD. That's why AMD stock cannot move higher while they're buying Xilinx. So that's what's happening to AMD. It's under this arbitrage trade that's affecting the performance of AMD stock. The company continues to do well. So CEO Lisa Su has said multiple times, and hopefully she will give us some indication when AMD reports next week about when this deal is supposed to close, but it is supposed to close by the end of 2021. When it closes, people are going to cover their short by buying shares of AMD. Okay, so when people buy, there's going to be that buying pressure that's going to push AMD shares up. Also, something that we just noticed when we put this PowerPoint, this presentation together, is that AMD has a chart similar to other growth stocks that have broken out. So if you remember, you have been following us, you remember we presented a trade that we're still in Amazon. It had kind of a year of doing nothing, moving up and down, and Amazon broke out of that consolidation to all-time high, came back to retest, and it's now shooting higher again. So AMD has a similar setup to Amazon in terms of having this flagpole here and having this flag that lasts for a year. So since September of last year to now, the stock is still at the high 90s. So we believe AMD is breaking out here. So that's why we put it's a screaming buy. You can buy it right here, right now. Buy more if it gets above all-time high. Don't be hesitate buying it. And then I believe this is last. American Eagle Outfitters. Sound familiar? This is a retailer. They sell clothes, denim. Okay. Factors that affect this stock the most include recovery from COVID, because certainly reopening of stores is going to boost its sales. But this company is doing well online as well, so maybe not a big factor, but certainly consumer demand for their product is going to dictate how the stock will perform. So talking about those 2 points, U.S. recovery is very solid. You know about that. We're fully open. The Delta variant is coming back and bite us in the rear, but the U.S. vaccine is very effective. Moderna, Pfizer, some of Johnson & Johnson is very effective. They say you don't have to worry about Delta variant. So the recovery in the United States is solid. Internationally, may not be too big of a worry, because this company, this retailer, this clothes retailer, has the least international exposure when compared to Levi, when compared to Gap. AEO, American Eagle Outfitters, very good. And then lastly, let's talk about demand. Demand for AEO is through the roof. You have, when you listen to the banks, so Bank of America, JP Morgan, their conference call, they say that the United States consumers, their balance, the bank accounts, is strongest that it has ever been. So you have all the stimulus money from the government, and people were still getting paid to go to work. Working online. So the consumer is not lacking money. They're flushed with cash. So certainly that is a strength. And when people have money, they're going to buy more clothes. Coming out of the pandemic, people are going to gain weight. so they have to buy new clothes. Okay. Stylistic changes. You haven't seen each other in a while. You see somebody has a nice pair of pants. You like that pair. You're gonna buy it. Stylistic or fitness change. That's demand. And then these 2 points we should put together: the back to school season and the is a big push for this stock. So back to school, you have kids coming back to school, university students going back to university. That's a back to school season, usually a huge spending catalyst for a retailer. And you're getting this child credit, this stimulus from the government, still paying now for families with children. So it's a monthly payment to the family, or families can take it as kind of a lump sum too. The government is giving money to consumers still, so this should be good for the stock. So we're buying this stock fist over palm, fist over hand is the expression that they're saying when it's such a really good deal that you have to snatch it, buying fist over palm. So American Eagle Outfitters, and in fact, I believe this is, you can read about our analysis in AEO here on our website. You can read about our analysis for all of the stocks that we own on our website. We just want to direct your attention to that. And that is it for us this month. Thank you very much for watching, and I will see you next month.